Warren Buffett has a problem. Not a bad problem. The kind most investors would kill for. In late Norseri, he quietly bought equal stakes in all 5 of Japan's largest trading companies. The bet paid off spectacularly. By early Norseluk, according to Fortune, Berkshire Hathaway had made $30 billion on that single call in just 6 years. The position is now worth north of $30 billion.
But here's the thing about buying all 5 at once. You're not really making a judgment call about individual companies. You're making a bet on a category, and Buffett knows this, which is why in March Berkshire quietly raised its stakes in all 5 to between March and nearly 0%, and then by August March pushed Mitsubishi past the 0% threshold.
At some point, though, the category trade becomes a stock-picking exercise, because these 5 companies are not interchangeable. They have radically different personalities, bets, and futures.
So today we're going to do what Buffett's already done behind closed doors: rank the 5 Sogo Shosha, Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo, and figure out which one is the best long-term bet. If you're only keeping one, which one do you keep?
If you saw our earlier episode on the Sogo Shosha, that's episode Sen, you know how this model works at a high level. The quick version: these aren't conglomerates in the Western sense. They're not just holding companies that own unrelated businesses for financial diversification. They're operational networks, global project developers, deal makers, and supply chain engineers who build the infrastructure that keeps modern economies running. They own mines, power plants, grain elevators, convenience stores, chemical plants, and RNG facilities on 6 continents.
What makes them remarkable is the yen carry trade at the heart of Buffett's insight. They borrow in cheap Japanese yen, invest in productive global assets, earn hard currency returns, and return capital to shareholders through a combination of growing dividends and aggressive buybacks. The average return since Buffett's initial disclosure has been %, with dividends up roughly %.
But if those broad characteristics apply to all 5, where do the differences lie? The answer is in 4 dimensions: what they own, how well they allocate capital, how exposed they are to the energy transition risk, and whether their returns are sustainable for another decade.
Let's start at the top. Mitsubishi Corporation is the undisputed king of scale. As of early Nishiluk, its market capitalization is roughly $60 billion, making it not just the largest Sogo Shosho but one of the most valuable companies in Japan. Revenue runs at about $60 billion on a trailing 12-month basis. For the fiscal year ended March Mitsubishi reported consolidated net income of nearly billion, that's about $10 billion.
The portfolio spans everything: copper, RNZ, chemicals, food, machinery, automotive, finance, infrastructure. If a major global commodity or industrial sector has a meaningful presence in Japan, Mitsubishi probably has a stake somewhere in the value chain.
Mitsubishi's current strategy is called Enhance, Reshape, Create, and it targets 5% return on equity by fiscal year 2027. The company is simultaneously the most exposed to the energy transition. It has historically been one of the world's biggest RNG traders, and arguably the most credible in managing that transition. It's committed to doubling its renewable energy capacity from Santin San gigawatts in Nisenchu to Lukden Luk gigawatts by Nisen-senj, with capacity already at Santin Chu gigawatts as of late Nisen Year Sin, according to an analysis by Strategy Plus Business.
Wind and solar represent roughly half of the Ruin trillion it's committed to energy transformation. The total shareholder yield from Mitsubishi, combining dividends and buybacks, sits at around 9.4%, the highest in the group. For income-oriented investors, that's a compelling number.
The risk: Mitsubishi is so diversified that it can sometimes feel like owning a very large index fund of Japanese industrial interests. The breadth is a feature, but it also means the upside is capped. You're not making a focused bet. You're making a very well-managed, very large, very Japan bet.
Mitsui & Co. is often described as the deal maker of the group. Where Mitsubishi tends to run large integrated operations, Mitsui has historically excelled at identifying transformational opportunities early and structuring complex deals across borders. It was Mitsui that took early positions in the Pilbara iron ore mines in Western Australia. Those turned into multi-decade cash machines. It was Mitsui that structured some of the earliest large-scale air energy projects in the Middle East and Australia.
For the fiscal year ending March 2020, Mitsui is targeting profit of $800 billion, roughly $40 billion. In the first half of that fiscal year, profit came in at $5.9 up some % year-over-year. The company has raised its total investment budget to $9.7 trillion and significantly expanded its share repurchase program to $900 billion, a clear signal of capital discipline.
Berkshire Hathaway has been especially attentive to Mitsui. In March, Nitsan Arsawoop Berkshire raised its Mitsui stake to %, and by late Nitsan Arsawoop had crossed the sure % threshold, the first of the 5 to technically breach the original ceiling Buffett had agreed to. As reported by the Japan Times, Mitsui is viewed as particularly well-positioned on energy transition, with a growing commitment to clean ammonia projects alongside CF Industries and a revised RNG strategy that balances long-term supply obligations with decarbonization goals.
Morningstar's analysis of the Sogo Shosha identifies Mitsui and Marubeni as the two companies offering the most upside relative to their current valuations. The reason both still trade at a relative discount to peers, yet their portfolio quality has improved substantially over the past 5 years.
Total yield for Mitsui sits at around 9.5%. Like Mitsubishi, it's a high-yield, large-cap bet, but with a slightly more dynamic deal-making DNA.
If Mitsubishi is the conglomerate king and Mitsui is the deal maker, Itochu is the anomaly. In Japan, there's a long-standing assumption that the big money in Sogo Shosha comes from resources, oil, gas, metals, minerals. Itochu, for most of the 20th century, was a relative outsider in that conversation. It was more focused on textiles and consumer goods than on extracting things from the ground. Many analysts treated it as the smaller, less glamorous member of the top 5.
Then something interesting happened. While the resource-heavy players spent the 2010s on a boom-bust roller coaster driven by commodity prices, Itochu doubled down on consumer and known resource businesses. It made a bold bet on Family Mart, one of Japan's largest convenience store chains, eventually taking it private. It locked in a strategic alliance with Itochu Limited, China's largest state-owned conglomerate, via a Rupiah billion joint investment with Thailand's Charoen Pokon Group in Nissan Multane, and it aggressively shifted its profit mix toward businesses with more predictable consumer-driven cash flows.
The results are difficult to argue with. For the fiscal year ended March, Itochu posted record-high consolidated net profit of $800 billion, roughly $1.9 billion, representing approximately 4% growth over the prior year. Return on equity sits at around 4%, the highest in the peer group. For fiscal year 4% $900 billion, which would be a second consecutive record.
According to Morningstar's analysis, Itochu earns the highest capital allocation rating among the 5. They rate it exemplary, and is the only one expected to maintain excess returns for at least 10 years with moderate or lower risk of value destruction. That's a remarkable distinction in a peer group that's already outperforming the global average.
But Itochu carries a distinctive risk that the others don't: China exposure. The Itochu stake, while strategically valuable, means Itochu has significant asset and earnings exposure to a Chinese economy that's in a complicated moment, slowing growth, property sector stress, and ongoing US-China geopolitical friction. Itochu's own risk disclosures note that its China-related business impact is extremely limited beyond SHITIC, but SHIT itself has real estate exposure and industrial diversification that's harder to evaluate from the outside.
The other side of the coin, the premium investors pay for Itochu's quality, is the highest in the group. It trades at the highest price-to-book ratio of the five, which means less upside if you're buying today and more downside if the known resource thesis hits a speed bump.
Total yield is around trade rates lower than Mitsubishi or Mitsui, but that's partly because the share price has already re-rated to reflect Itochu's superior profitability.
Marubeni is the specialist's pick. While the other four are broadly diversified, Marubeni has a particularly concentrated identity. It's the food and agriculture powerhouse of the group. Through its ownership of Gavilan, one of the largest grain trading and handling companies in the United States, Marubeni sits at the center of global food supply chains. It handles a meaningful share of U.S. grain exports, corn, soybeans, wheat, and has built an integrated agribusiness that runs from Brazilian farmland all the way to Asian consumer plates.
For the fiscal year ended March 2025, Marubeni reported net profit of 500 billion, around 1.4 billion, which was its second highest ever. The forecast for fiscal year 2026 is 500 billion. In the first quarter of that fiscal year, profit came in at 200 billion, up 10% year-over-year.
What makes Marubeni interesting right now is its strategic pivot. The company has been deliberately rotating away from thermal coal and commodity volume plays toward what it calls higher quality assets, grid-tied renewables, data center power solutions, copper in South America, and value-added food processing. This is a portfolio that's genuinely repositioning for a different economy, one where data and food security are as critical as oil and gas.
Morningstar's analysis agrees with this direction, flagging Marubeni alongside Mitsui as offering the most upside to estimated fair value. The total yield sits at around 0.5%.
The risk is asymmetric. If global food prices stay elevated, driven by climate disruption, geopolitical supply chain fragmentation, or both, Marubeni's agri-exposure is a massive tailwind. If commodity cycles turn, it's a headwind. And while the company talks about data center power solutions and renewables, it's still early days in building those as meaningful revenue contributors.
For patient, value-oriented investors, Marubeni is the most interesting valuation story in the group. Sumitomo Corporation is the quietest of the five, and that's not a criticism. It's a description of an investing style.
Where Itochu made a bold bet on China and consumer goods, and where Marubeni built an agri-empire in the American heartland, Sumitomo has stayed closer to its historical core metals, minerals, and infrastructure, supplemented by steady growth in media, IT services, and real estate. Think of it as the most disciplined, most traditional member of the peer group.
For fiscal year Isensu, Sumitomo reported net profit of 5.2 billion. The fiscal year Isensu forecast is 5 billion. The company has launched a share buyback program of up to 1 billion and raised its annual dividend to 6 yen per share for fiscal year Isensu Ugasho, a 10 yen increase over the prior year. Total yield runs at around 4.58%.
Sumitomo's capital return policy as laid out in its medium-term management plan targets a total payout ratio of 40% or higher with progressive dividends, the explicit promise that dividends will rise over time rather than fluctuate with earnings.
The knock on Sumitomo is that it lacks the narrative momentum of its peers. Itochu has the non-resource winner story, Marubeni has the food security story, Mitsui has the deal maker goes clean story. Sumitomo's story is we're solid, we're consistent, and we return capital reliably. That's not a bad story, but it doesn't attract the premium multiple that the stronger narratives command.
So how do we rank them? Let's be clear about what we're ranking for. If you're buying all 5 as Buffett essentially has, you're capturing the category return, which has been exceptional. But if you're making a focused bet, you need a framework.
I'd suggest 3 tests: return, sustainability, valuation, and the energy transition. On return sustainability, Itochu wins clearly. It's the only one with an exemplary capital allocation rating, a TXUG% ROE, and an analyst consensus that its excess returns can persist for a decade or more. That's rare in any market, let alone among large industrials.
On valuation, Marubeni and Mitsui offer the most runway from current prices. Both have improved their portfolio quality significantly but haven't yet received full credit from the market. If you believe their strategic pivots are real, and the evidence suggests they are, these are where the value is.
On energy transition, Mitsubishi is the most credible at managing the journey. It has the most energy exposure, but it also has the most explicit and arguably most achievable decarbonization roadmap.
My ranking Itochu, Mitsui, Mitsubishi, Marubeni, Sumitomo. But here's the important caveat. Each of these rankings could shift based on one macro variable, the US-China relationship. If geopolitical tensions escalate meaningfully, Itochu's SHIITIC exposure becomes a real liability, and suddenly Mitsui's America's heavy portfolio looks more attractive. If the global energy transition accelerates faster than expected, Mitsubishi and Mitsui's LRNU exposure becomes a drag, while Marubeni's renewables and agri-pivot looks prescient.
And this is perhaps the most interesting thing about the 5 Sogo Shosha in Nisen Nisaluten. Each one is a different bet on how the world develops. Mitsubishi is a bet on managed transition, the idea that energy remains critical for decades, and that a disciplined incumbent can lead the decarbonization journey. Mitsui is a bet on global deal-making acuity, that the company which identified the Pilbara and Texas energy early can identify the next transformational opportunity before the market sees it.
E2 is a bet on consumer durability, that known resource, consumer-facing businesses will outperform in a world where commodity cycles are too volatile to build long-term returns on. Marubeni is a bet on food and data as the scarcest resources of the 21st century. Sumitomo is a bet on boring consistency, that in a world of narrative-driven markets, the quiet compounder eventually wins.
Buffett bought all 5 because he recognized that the category was undervalued. He may be keeping all 5 because he recognizes that the outcome is uncertain, and owning the range is wiser than picking one winner.
But there's something deeper here. The 5 Sogo Shosha are not just investment vehicles. They're a window into 5 different theories of Japan's future role in the global economy. Will Japan remain a resource infrastructure powerhouse, a consumer and technology hub, a food security provider, an energy transition leader?
In a world that's fragmenting into regional blocks, supply chain nationalism, and competing industrial policies, the ability to sit at the intersection of buyers and sellers across every category, which is exactly what the Sogo Shosha do, might be the most valuable capability in global commerce.
That's not a bad thesis for a company that's been refining it since the Meiji Restoration. The real question now is whether the next generation of investors will get to buy these at Buffett prices, or whether the days of trading below book value are permanently behind them.
Morningstar's analysis suggests there's still 100% upside across the group. Whether that materializes depends less on what these companies do and more on whether global markets continue to underestimate what these companies are. If history is any guide, the underestimation tends to last longer than it should.